Hey everyone, thanks for tuning in to our October 2025 Investment Committee update. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. The U.S. federal government shutdown continued through October and is starting to have a negative effect on the real economy. U.S. labor market continues to weaken as the most recent monthly data from ADP showed a loss of 32,000 jobs. Surveys from the private sector have come into focus since the official U.S. government data isn't available during the shutdown. This data from October reinforces the negative trend in the labor market that has persisted for several months. Additionally, over the past 2 months, we have seen multiple Fortune 1000 companies announcing significant workforce reductions due to the utilization of AI in their operations, a trend that will likely continue. Ongoing contraction in the labor force is adding strain to an already stressed consumer. Stephen will review updated data that is signaling a significant slowdown in consumer spending patterns and deterioration in many parts of the credit market. Now, despite these concerning developments in the economy, the stock market managed to nudge higher in October, and the longer-term uptrends remain in place across most areas of the global stock market. However, during October, we saw some of the worst market breadth ever recorded, and much of the recent gains have been concentrated in the lowest quality stocks, as defined by debt-to-equity ratios, return on equity ratios, and price-to-free cash flow ratios. In fact, the recent surge in speculative activity in the lowest quality parts of the market is on par with the same market action we observed near the peak of the internet bubble back in 2000. A multitude of warning signs within the market have us focused on being ready for a change in the market environment and the need for prudent risk management. So with that, I'm now going to turn it over to Stephen to walk us through this month's review.
All right, thank you, Chad. So as always, we're going to jump in and we're going to set the scene with a broad perspective of what's going on here in the economy. So the federal government has been shut down, as Chad mentioned, for over a month now. And while most federal workers will be eligible for back pay, missing paychecks is not a good thing for families. Furthermore, the expiration of SNAP benefits places even more vulnerable citizens under further economic stress. So, for additional reference, SNAP benefits now cover over 41 million people, which is nearly 12.5% of the U.S. population. As I quipped in our October newsletter, the American people are once again pawns in Washington's game and their quest for power. And they could come to terms on a continuing resolution to fund the essential services of the government while they quarrel about broader issues, but they refuse to do that as they think it diminishes their leverage. Of course, all this is happening under an already souring economic backdrop. The labor market continues to soften. The ADP report showed a loss of 32,000 jobs. We're due for another report in early November that's likely to show maybe more of the same. And it's been several months since we spoke about it, but we're now starting to see this come to fruition. Several months back, we shared excerpts from a conversation with our friend Larry McDonald at the Bear Traps Report, where he and his team were growing concerned that Wall Street strategists were underappreciating the prospect of AI-related job losses. And while we are skeptical about the feasibility and time frame in which AI can scale, we do believe that that technology is going to have lasting impacts on our society. But it appears that the transition from today's world into the future is going to be bumpy at best. In their latest earnings release, Amazon said that they're going to cut 14,000 corporate jobs due to factors such as AI, and they ultimately plan to reduce their workforce by 22%. And that's substantial. It's from a single company, and so this could very well just be the tip of the iceberg. Ronald Reagan once said that the difference between a recession and a depression is that a recession is what happens when your neighbor loses their job. A depression is what happens when you lose yours. Either way, we are facing macroeconomic headwinds in this country, and we need serious folks to solve them. So that said, the economic challenges for many Americans continue. I want you to watch this recent clip from CNN highlighting increased delinquency rates in subprime auto loans and the struggles that are facing many consumers. Take a listen.
A certain group of Americans, borrowers, struggling to make their monthly car payments. CNN Matt Egan here with some of the details. Who are we talking about?
Yeah, well, we're talking about subprime borrowers, which are people who have lower credit scores. And this is a concerning trend because historically people would prioritize car payments over just about everything else, right? You need your car to get to work, to take care of your family, but some people are falling behind. Look at this, 6.4% of subprime borrowers are 60 days or more late. That's higher than during COVID, higher than during the 2008 financial crisis, the second highest reading on records that go back to the early 1990s. The only time it was higher was January of this year. Now, this isn't a brand new trend. These delinquencies have been elevated for the past 2 years or so, but this is getting some more attention because there was a subprime lender in Texas that went bankrupt, and that was rattling investors. So why is this happening? Well, part of this is just because life is very expensive right now, right? Groceries, daycare, rent, mortgage payment. But it's also because owning a car is really expensive right now. Look at this. If you're looking at average monthly payment on a new car loan, almost half of those new loans have payments of $700 or more per month.
That's a lot of money.
It is, and a significant amount are actually above $1,000 a month. But then there's also the cost of just having a car, right? Car insurance has gotten much more expensive over the past year. It's 5%, and car repair 15% increase over the past year. And we know that car parts are exposed to the president's tariffs. So this just shows the pressure that some consumers are under. Now, the fact that some people are falling behind on their car loans, this has been good for the repo business. Car repossessions last year, almost 2 million, the highest since 2009 during the Great Recession. And I talked to the owner of a car repossession business in Texas, and he said, look, business has been good. He described it as a target-rich environment at this moment. So, John, look, bottom line, I don't see this as a brand new warning sign for the economy. It's actually been one that's been staring us in the face for a bit, but it does make you wonder if this many people are behind on their car loans now, what happens if unemployment spikes or the market plunges or both?
Well, there are a number of comments from that video that make my ears perk up. Sounds all too familiar. How about you? All right. Well, let's move on here. So I thought that clip did a nice job showcasing where American consumers are spending a lot of their discretionary money right now. It's on car payments, car insurance, and the year-over-year increases. So that means they likely have less money to go around for things like food, restaurants. And we see that corroborated in this chart to some extent where we're tracking the price performance of some select publicly traded restaurant chains. So I'm not bringing this up to make a recommendation to buy or sell these companies. It's just to try to get a glimpse as to how these companies are faring so far in 2025. We've got McDonald's and Yum Brands, right? So Yum Brands would be Taco Bell and KFC. They're the only two that are above water. Darden Restaurants, which is Olive Garden, is kind of basically flat, and it gets worse from there. Domino's, Texas Roadhouse, Starbucks, Brinker, symbol EAT, which is Chili's and Maggiano's, down almost 18%. Cracker Barrel down 35%, Wendy's down 45%, Chipotle down 47%, and Cava down over 50%. So some bull market that we're in there, huh? Well, more on that point. So we set a record towards the end of October, perhaps two records, right? The first record being that the S&P 500 index, it closed at a new high. But, and this is quite the ironic but, if you were to look at every single trading day that has occurred since 1990, where the S&P 500 closed higher for the day, You would not find a single other occurrence where so many of the stocks within the S&P 500 index closed the day in the red, down, when the market was actually up. So what's referred to as net gainers or net advancers, you take the number of stocks within the S&P 500 index that gained value during that day's trading, and you subtract the number of companies whose stocks fell. So on this particular day, the 29th of October, we had just over 100 stocks within the S&P 500 that closed the day higher, but nearly 400 were down, right? So our net advancers was almost minus 300. So that's an 80% down day. 400 stocks of the 500 are negative on the day. The market still managed to close up by 0.2%, right? Because its largest components, a lot of these AI-related names, buoyed it higher. Well, I, for one, don't find this type of market action to be encouraging. Now, the good news is that we are entering into what is historically a bullish time of year for stocks. Although we did ignore some seasonal trends earlier this year, so the most bullish 6 months of the year is always November through the end of April. And so we see that that is a period where historically, right, we're looking at the composite here where markets are generally trending higher. And then the summer typically gets kind of choppy, maybe moves down a little bit, and then is bullish towards the end of the year. Well, we've kind of defied those seasonal tendencies a couple times this year because the market certainly was not bullish in the first quarter when it historically is, and then it wasn't weak during the summer, which it typically is. So is it finally going to return to be in lockstep with the historical tendencies here, and are we going to see a strong Q4 rally? To be determined. But as we'll see in a little bit, the trends in the market are still favorable, even though we definitely have some concerning issues with market breadth. Okay, so let's move on, and we're going to start to go through some of the charts of the key asset classes that we follow, and we're going to begin with large cap U.S. stocks as represented here by the S&P 500 index. And so we can see that it remains in an uptrend that started back in May following that Liberation Day sell-off from earlier this year. New all-time highs for the S&P 500 in October, up about 2% for the month. Much of that driven once again by these mega cap technology companies. Mid caps also remain in an uptrend, although they were actually down by about 0.5% in the month of October, but we can still see that they are underwater even from their former highs late last year. So still not a ton of progress in the last 12 months for mid caps in an uptrend, and ultimately we want to see them take out these former highs. Small cap stocks managed just short of a 2% gain in October, remain in an uptrend. Very important level here for the Russell 2000 index. It has just eclipsed this prior high from October of 2021. Are we going to get a sustained breakout? All right. So time is going to tell, but we've got our fingers crossed. The trend is in the right direction. So we want to continue to remain invested in this space. Developed international stocks also remain in an uptrend and are still among the best performing stocks globally in 2025. Up about 1% in the month of October, pulling further and further away from those former highs from 2007 and 2021. 2007, 18 years worth of no advance, but we have now broken out and are continuing higher. So we continue to believe that many investors are still meaningfully underweight this category, and they are working. They are working. Emerging markets had a strong October, up 4% for the month, but we are retesting these former highs from 2021, but also 2007. So this asset class has performed really strongly here in 2025, but it could be due for a breather, right? It would not surprise me as we're running into these former highs if we chopped around for a little bit at these levels. We could see volatility pick back up in the emerging market space for a little bit of time as we challenge those former highs. But once this one breaks, kind of like what we just saw in the international space, the developed international space, once this one breaks, there could be a lot of pent-up energy in this area of the market. A breakout here above these former highs would be very bullish. But in the interim, expect some choppiness. All right, let's move on to the bond market. The U.S. Aggregate Bond Index, it too remains in an uptrend. Now, the Fed did lower rates by another quarter point at the end of October. Lower rates typically are going to translate to higher prices for bonds, but we expect that the market has already moved to price in a lot of the future rate cuts from the Fed. In fact, when the Fed announced that they were cutting rates on the 29th of October, there were dissenting opinions about whether or not there was going to be another cut in December. And we actually saw interest rates start to move higher. So we saw the yield on the 10-year U.S. Treasury move from where it was under 4% back to around 4.1%. So the market is skeptical about the level of future interest rate cuts. Let's move on here. We're going to look at commodities. They've just kind of continued their sideways grind, so not much of a trend here in the commodity space, although we do believe that we're maybe seeing some bottoming signs here at the same level where the index found support back here in 2021. But until it can really sustain a move higher above this level that it's been stuck underneath for the last couple of years, I think that we've got to define what this asset category is doing is trendless. But maybe things are changing for the better here for commodities. So we're going to wrap up this overview with a quick look at real estate, the real estate investment trusts here, the Dow Jones Equity REIT Index. It also appears to be trendless, but it has just kind of remained sideways on a sideways grind for a number of months and even quarters now. That is it for our big picture overview. So if you are watching this public version here on YouTube, this is where our review for the month is going to conclude. Now for our clients, this review continues and we highlight the holdings that we currently own within our managed strategies. Now, if you're interested in learning more about our managed strategies, send us an email to info@reveillewealth.com and we will follow up with you. But for now, I'm going to pass it back to Chad for a recap, and then I'm going to leave us with some final thoughts. Chad?
Thanks, Stephen, for that update. So to recap, ongoing contraction in the labor force is adding strain to an already stressed consumer. Yet despite concerning developments in the economy, the stock market managed to nudge higher in October, and the longer-term uptrends in place across most areas of the global stock market remain intact. However, warning signs are emerging that must be heeded. Some of these include excessive levels of stock market valuation in the U.S., especially in the large cap area of the market, both on a relative basis and historically. Overconcentration in the AI theme within the market and the economy. Negative market breadth, which in October was some of the worst we've seen recorded. Speculative activity in low-quality stocks of late. Deterioration in consumer spending patterns and in certain areas of the credit markets. And lastly, ongoing contraction in the labor market, which has been exacerbated by the government shutdown. Now, we do still remain almost fully invested because of ongoing uptrends, and we could get a tailwind in the markets from a seasonality perspective. But a multitude of warning signs within the markets have us focused on being ready for a change in the market environment and the need for prudent risk management. With that, I'm going to leave it over to Stephen for some final thoughts.
All right, thanks again, Chad. Appreciate that. Thank you, everybody, for tuning in. We hope that this review has been insightful for you. If you have any other questions for us, always feel free to reach out to us at info@reveillewealth.com. We hope everybody has a wonderful Thanksgiving, and we will look forward to catching up with you again in early December for the November review. Take care, everybody, and we'll see you next time.